right, everyone. So a bit of an impromptu recording here. Big news event today, of course. You trade the markets or follow the markets, you know that today on June 15th, there was a Fed meeting and the Federal Reserve has indeed raised interest rates by 0.75 or 3/4 of a basis point, the biggest increase since 1994. But before we take a look at this kind of stuff or what comes next, right? Because I'm sure everyone wants to know what comes after this big rate hike here. I just want to focus you guys on EQUITY.GURU, our website. We've been talking about basically this whole idea of inflation and non-monetary and monetary inflation, what the Fed and other central banks have to do to control the monetary side, what they're going to have to do to control the non-monetary side. And funnily enough, just the day before this article, or the day before the Fed meeting, I wrote about the bond markets because you guys sort of know me. I like to follow what's happening in the debt markets, and we saw an epic move in that 10-year yield, indicating that rates are going to go higher or above the normal range of 2 to 3% that the Fed told us. But there's been crazy things happening in Japan and also in Europe. And just before the Fed went live, we had the European Central Bank. And if you recall, they have gone hawkish, like many central banks, and they're now saying that they're going to get their or give their first rate hike, 25 basis point rate hike in July, taking rates from negative 0.50 to negative 0.25, and hopefully be positive by September. And basically, the European Union or the ECB, stand corrected, has been in negative rates since 2014. Well, the Italian yields, so the bonds on the yields on the Italian bonds, they've been just skyrocketing. Italy had an emergency meeting with the EU on budget. Nothing was agreed on. And then this happened. The European Central Bank had a surprise emergency meeting to address higher borrowing costs for many European governments. The Italians are one, and the Greek bonds as well were going up. And it's funny because a lot of people are now saying that the ECB is already maybe pivoting, that instead of going hawkish and raising rates come July, they might be turning around and sticking with the easy monetary policy. It is a bit tough in Europe, right? Because again, each of these countries have their own bond markets and their own debt. And, Ireland is growing by like 10%. They have a GDP of 10%, whereas France has like a growth rate of 0.2%. So of course, when you're dealing with interest rates, rising it might help one, but harm the other. So there's a big issue sort of there with the ECB, and that's why a lot of people say the ECB is sort of, in a way stuck and can't really do great things, or can't do many things. Well, okay, so this is sort of big news in my opinion, right? Where it looks like the ECB is already beginning to pivot. We'll find out later on. Apparently they're coming up with some sort of new tool that's going to tackle the risk of rising bond yields. And I've been asking around, talking to people, and it's sort of like, hey, the only tool they really have is buying bonds again, right? Sticking with easy monetary policy. And I don't believe we're going to be seeing the ECB, doing easy monetary policy, buying bonds, and also raising rates at the same time. So keep this in mind, because I think it's really important for the interest rate differentials. And then, of course, we come to the Fed meeting where market was expecting a rate hike of 0.50, however, or half a basis point. However, after Friday's inflation numbers, which showed inflation was still running away, the market wanted more action. 0.75% was priced in today. There were even rumors about a 1% hike potentially. I just want to read or share with you guys Bill Ackman's take, because it's quite similar to my take. And, he said, hey, look, the Fed has allowed inflation to get out of control. Equity and the credit markets or the debt markets have lost confidence. Market confidence can be restored if the Fed starts to take aggressive action to basically show that they're serious about combating inflation here. And, he was saying the Fed has to raise rates by 75 basis points tomorrow and in July. Have this commitment, say they're, have this really strong commitment that they're going to tame inflation. Obviously, he sort of says, Paul Volcker needed federal funds rates at 20% for similar levels of inflation. I don't think we'll be able to beat it at 4%, but hopefully, between 5 to 6%, we can tame inflation, and hopefully the Fed gets there rather quickly. Well, if we take a look at the Fed dot plot, you can see here by the end of this year now, the dot plot is showing that there's a year-end projection for the federal funds rate to move up to 3.4%, and the estimate for the end of 2023 is around 3.8%. And again, Fed has raised rates by 75 basis points. The Fed has said here that this type of hike obviously is unusually a large one. And Powell says that he does not expect moves of this size to be common, although he did say in July, be prepared to see an increase of 50 or 75 basis points. But the decision will be made meeting by meeting, because it all depends on those monthly inflation data to see if it's beginning to drop, because if it is beginning to drop or taper, then not taper, sorry, it's transitory was the other one. And then it was peak inflation, right? To see if inflation is peaking. If that's the case, then we can begin to lessen the amount of rate hikes. So it looks like we're expecting a big rate hike in July, and then we'll have to see what happens in September, November, and then of course December. The estimate or the dot plot is showing that individuals in the Fed are revising upwards what they think interest rates are going to be. It's an upward revision of 1.5% from March estimates. So of course, I guess the Federal Reserve was thinking, hey, inflation will be peaking and we won't have to take rates as high as we thought we would. And obviously that's not the case. So a lot of people are sort of worried now that maybe the Fed is already way behind the curve, right? And they're doing these rate hikes as a desperate way to try to beat inflation or to get ahead of inflation, but obviously there's already quite a big discrepancy there. So, I don't think I'd be surprised if we see another 75 basis point hike come July, but the big question obviously going forward is what's this going to do to the consumer, right? Inflation is rapidly rising. Interest rates are also going up, so it's more expensive to borrow money, and mortgage rates in the U.S. are a whole different story. They've gone up by 1% within a week there, the 30-year mortgage in the U.S. So will rising interest rates cause a recession, right? Will that be enough to slow down demand? Because on the non-monetary inflation side, there's this supply and demand imbalance, obviously, with supply chains and all that kind of stuff. And the idea is, you want to try to lessen or kill demand in a way, right? To try to deal with inflation. Of course, Volcker did that, in a big way with taking rates up to 20% and caused a severe recession in the US. So maybe that's the playbook, right? The US economy looks like it's probably heading towards a recession because Q1 was negative. If Q2 is also negative, the US is officially in a recession. And from there, we're hoping that the inflation data will begin to peak, right? Because obviously, if we have a recession and the inflation data is still going out of control, the Fed will have to raise rates if they're still serious about taming inflation. So big rate hike today. How did the markets react? That's the big question. So let's go to the S&P 500. And let's go to intraday, because I think that's what people want to see. Take a guess when the rate decision occurred. It started here with this big candle, big red sell-off, and then from there intraday during the Powell press conference, we began to strengthen. And I guess in this way, the market likes what Powell is saying, right? That hey, the Fed has the tools and is serious about combating interest rate or inflation, and they will be rising interest rates to do so. However, as rates go higher, I'm still thinking money's going to be looking at other, avenues for safety, I guess, right? Perhaps even bonds, perhaps even the U.S. dollar. But we'll have to wait and see, right? This is one green day. I'm not saying that we're going to start a new bull trend from here. I think the markets are still a bit uncertain, right? Because obviously now you're going to be pricing in a recession, but other people would say that's actually positive because a recession would mean maybe the Fed switches back to easy monetary policy. But from a technical perspective, because you guys know I love my technicals. We are still at a resistance zone, just the lows here around 3,900. And you can see I'm using the candle wick here. And funnily enough, that's where we're actually rejecting as we bid up a little bit today. So it's going to be interesting to see the follow-up. As a technical trader, I'm not turning bullish on markets just yet. I will turn bullish once we take out 4,200 or 420 on the the SPY, is a very similar level. But that's the technical level that I will be watching personally. Let's take a look at two more charts here very quickly, the US dollar and of course gold. So US dollar intraday, let's take a look at the 5-minute. We'll talk about the daily in just a second. But yeah, you can see the dollar initially spiked. We began to find some resistance at 105.65. And then we had this sell-off here in the dollar, breaking intraday support as well at 104.75, although we are now back above that intraday support. And I think, you know, it's great just to see the volatility intraday to see what happens. But I trade based on the daily or the long-term charts. And you can see we actually did break out above 104.75, which was previous highs for 2022 on the US dollar. And we're just retesting it, that breakout zone. So you can see yesterday we had buyers step in. Today we are also having buyers step in. So we haven't really broken that down, although I could see, you know, a potential retracement in the dollar, given it just needs one, because we've had like 4 green days in a row. But we would have to break back below this 104.75. Although I was just going to say, lost my train of thought there for a second, but with what's happened with the European Central Bank, you know, the dollar or the Fed is quite the hawkish central bank, right? Still one of the most hawkish central bank. And of course, the dollar index has a large composition of the euro, right? The euro, US dollar, and Dixie chart are basically inverses of each other. So it's going to be interesting to see what happens with that European Central Bank data, because I think that news was quite big. And it's funny that it happened, you know, a day before the Federal Reserve. And then finally, gold, nice green day today, nice pop here. Although, like I said, well, we'll talk about it on the daily chart, but it's not something I'm too excited about just yet, because again, the thing about gold, yes, it is that inflation hedge. However, with rates rising, right, on the 10-year yield, real rates, I guess you could say in a way, are increasing, which obviously isn't usually the best for gold, right? Because if rates are going higher, gold as a safe haven, you know, it doesn't yield anything, right? So the idea of going into gold when rates are low is really positive. But in the case of, you know, and I'm talking about typical money right now, right? Obviously, I'm a contrarian. I think a lot of you guys are contrarians too, and still say that, hey, why would anyone want to be buying government bonds? But, you know, a lot of these, I guess, pension funds and other type of money sources are looking at government bonds. And, you know, you can read an article about what the Japanese are doing, because they've been the biggest buyers of US treasuries. I'm still hopeful for gold, but I really want to see gold come back and take out 1870 or 1875 here. Maybe we're going to be double bottoming here. Maybe this is the pattern that we have here with today's engulfing candle. But I just want to wait for that confirmation breakout, you know, get back above my broken trend line here and also my moving average before I can confirm that we are heading higher. So, you know, nice relief rallies on the stock market, on gold, on the dollar after days of either green candles or multiple red candles. What comes next, folks? Higher or more rate hikes, right? That's what the Fed is telling us. The dot plot is now looking for rates to be around 3.4% by the end of this year. So, you know, we'll take in another 75 basis point or 50 basis point hike next month, perhaps followed by a 50 basis point hike and then a 25 basis point hike somewhere near the end of the year. And the markets right now are acting positively because they wanted to see, as Bill Ackman said, right, they wanted confidence to be restored, to see that the Fed is doing what is necessary and has the tools that are necessary to combat inflation. If you guys watch the Fed Powell conference, that's actually how he started off, right? He stepped on the podium and said, hey, look, I know what we're doing might be hurting some Americans, but, you know, rest assured we have the tools and the ability to tame inflation, and then he went on to give his spiel. So it's all about confidence, right? This whole idea of central bank confidence is very, very important. And you know, Powell, when he speaks, I gotta say he does give that breath of confidence, right? A lot of people say he's a good talker or an eloquent talker. He controls himself, right? He's very calm and collected, and he doesn't really give any signs of being nervous or saying, "Oh man, I sort of messed up," right? Obviously, you don't want to hear a central banker say that. Although you know he did have a lot of questions where people asked him, "Hey, why do you hike by 75 basis points when you said in the last meeting you were only going to do 50? Do you think you messed up, or why didn't you hike 1%? Right? What's the difference?" And he answered those questions quite nicely in terms of sort of maintaining confidence and explaining, "Hey, look, we're going to be watching these inflation levels heading forward." So good day so far on the markets and stuff, on the markets, on the dollar, on gold. However, I'm not calling this as the bottom just yet, although it's going to be very important to see how the follow-up candles trade, right? If we see this momentum continue higher, or if we just sell off automatically. And, you know, I know people might hate me for this, but on the technicals, I'm still bearish on the markets for now, although I am hopeful that obviously, you know, we can climb back above that 420 level and then reverse a major weekly technical breakout. But that's it for me, folks. Let me know in the comments below if you guys think this is the market bottom, or if you think we still have ways to go lower. And maybe a very important question is, has the European Central Bank, have they capitulated? And do you think the Federal Reserve and other central banks might do the same, because they don't like to see interest rates or bond yields rise in a crazy manner in the debt markets? Will that be enough to scare these central banks to say, hey, you know, we're going back to easy monetary policy? So let me know in the comments below, and I'll catch you guys all in the next chart attack video.